The eternal debate for every income investor boils down to a simple choice. Do you chase the highest possible yield today, or do you plant the seeds for a massive harvest tomorrow? Today, we're settling this argument with hard data, long-term projections, and a clear framework so you can decide which path or which combination is the right one for your portfolio. Let's start by defining the two competing philosophies with absolute clarity. The dividend growth strategy is the tortoise in this race. Its primary goal is not a high starting yield, but a high annual growth rate of the dividend payout itself. You are investing in companies that are financially robust, with a proven history of consistently increasing their dividends year after year. Think of blue-chip giants like Johnson & Johnson, Procter & Gamble, or Microsoft. These companies typically generate massive cash flows that they reliably share with shareholders. The hallmarks of this strategy are a lower starting yield, often in the 2 to 3% range, but with a dividend growth rate that can consistently hit 8%, 10%, or even higher annually. ETFs that embody this approach include SCHD and DGRO. The entire thesis here is the power of compounding. You are sacrificing immediate cash flow for the promise of an exponentially growing income stream that will utterly dwarf what a high-yield strategy could ever provide. On the other side, we have the high-yield strategy, the hare. This approach is all about maximizing the current income you receive right now. The goal is simple: get as much cash into your pocket today as possible. This strategy invests in asset classes that are structured to pay out high distributions. This includes REITs, real estate investment trusts, BDCs, business development companies, and covered call ETFs like JEPI and SPYI. The yield here is the main attraction, typically starting at 5% and often reaching 8% or more. The trade-off is that this high current income often comes at the expense of dividend growth and share price appreciation. The underlying companies or funds are paying out most of their cash, leaving little to reinvest back into the business. Therefore, the dividend growth in a high-yield portfolio is often minimal, sometimes just keeping pace with inflation, and in some cases, dividends can be cut during economic downturns. Now, let's move beyond theory and into the hard numbers. This is where the true power of the dividend growth strategy reveals itself. To illustrate this, we will run a 30-year projection for a $100,000 initial investment, with dividends reinvested in both strategies. For our dividend growth portfolio, we'll assume a starting yield of 2.5% and a dividend growth rate of 10% per year. For our high-yield portfolio, we'll assume a starting yield of 6%, but with a minimal dividend growth rate of just 2% per year. In year one, the results overwhelmingly favor the high-yield approach. The high-yield portfolio generates $6,000 in annual income. The dividend growth portfolio generates only $2,500. That's less than half the income right out of the gate. This advantage continues for the first several years. By year 5, the high-yield portfolio pays out about $6,625 per year. The dividend growth portfolio has climbed to about $4,000. It's still behind, but the gap is closing. The inflection point typically occurs between year 8 and year 12. At year 10, the dividend growth portfolio now has an annual payout of roughly $6,500. The high-yield portfolio is paying about $7,300. The high-yield strategy is still ahead, but by a much smaller margin. By year 15, the divergence becomes dramatic. The dividend growth portfolio's annual income has exploded to nearly $10,500. The high-yield portfolio's income has only crept up to around $8,100. The dividend growth investor is now receiving over $2,000 more per year. By year 20, the difference is staggering. The dividend growth portfolio is generating over $16,800 in annual income. The high-yield portfolio is at about $9,800. At year 25, the numbers are $27,000 versus $11,800. And at year 30, the dividend growth strategy pays out a colossal $43,600 in a single year. The high yield strategy pays $14,700. The dividend growth income is 3 times larger. From the same starting point, one strategy is generating over $3,600 per month, while the other is generating about $1,225. This is the mathematical magic of compounding dividend growth. But income is only one part of the equation. Because dividend growth companies reinvest profits back into their businesses, they typically experience stronger share price appreciation. Let's assume the high-yield portfolio has a total return of 7% annually. The dividend growth portfolio achieves a 9% annual total return. After 30 years, the $100,000 in the high-yield portfolio grows to about $761,000. However, the dividend growth portfolio grows to approximately $1.33 million. The combination of a vastly higher income stream and a portfolio value that is 75% larger creates a wealth gap that is almost incomprehensible. So, does this mean the high-yield strategy is useless? Absolutely not. Its value is in meeting specific financial needs. The high-yield approach wins in 2 key scenarios. The first is a short time horizon. If you are retiring in 5 years and need to maximize income immediately, you cannot wait 15 years for dividend growth to overtake. The second scenario is for investors already in retirement, relying on their portfolio to cover living expenses. Living off the 6 to 7% natural yield is more ideal than drawing from a lower-yielding portfolio and selling shares. The most intelligent approach for most investors is a dynamic hybrid model that evolves with your age and financial goals. This is the core of a life cycle dividend investing strategy. Think of dividend growth as your engine for building wealth and high yield as your tool for harvesting income. If you are in the accumulation phase between ages 25 and 45, your primary goal is maximizing your future income-generating machine. At this stage, focus overwhelmingly on dividend growth. A sample allocation could be 80% dividend growth and 20% high yield. Reinvest all dividends rigorously. As you approach peak earning years, from ages 45 to 60, your strategy should begin its gradual shift. This is the transition phase. A balanced allocation here might be 60% dividend growth and 40% high yield. This boosts your current income while the dividend growth portion continues to compound. Finally, once you enter retirement, typically from age 60 and beyond, your goal shifts to generating reliable income while providing some growth to combat inflation. A sample retirement allocation could be 30% dividend growth and 70% high yield. The 30% is your inflation-fighting engine. The 70% in high-yield assets provides the bulk of the stable income you need without constantly selling shares. Let's look at how these philosophies feel in the real world. When volatility strikes, the high-yield investor feels more secure. Why? Because even if their portfolio value dips 15%, that 7% annual yield keeps rolling in like clockwork. Those steady dividends feel like emotional armor. The dividend growth investor's patience is tested during early years. Watching others earn 2 or 3 times more income can sting. It takes conviction to trust compounding you can't yet see. But that patience is exactly what separates the average investor from the financially free. Think about Warren Buffett and Coca-Cola. Back in 1994, Coke paid just 23 cents per share annually. Today, it pays over $1.80. That's almost an 8-fold increase. Buffett's original yield on cost is now over 50%. That's the real magic of dividend growth compounding quietly. Picture 2 investors, Sarah and Tom. Both start with $100,000 at age 30. Sarah chooses dividend growth stocks with a 2.5% yield and 10% growth rate. Tom picks high-yield ETFs, paying 7% but growing only 1.5% per year. For the first decade, Tom feels like the winner. By age 40, Sarah's portfolio has quietly snowballed. Her annual income now surpasses Tom's, and her portfolio value is far higher. By age 60, Sarah's dividends alone exceed Tom's total income and capital combined. This isn't luck, it's math amplified by time. This math holds up across market history. The Dividend Aristocrats Index tracks companies that have increased dividends for 25 consecutive years or more. Over the past 30 years, Dividend Aristocrats have outperformed the S&P 500 with lower volatility. That's higher returns with less risk. Consistent dividend growth forces financial discipline. Companies that raise dividends every year manage debt carefully and prioritize shareholder value. Contrast that with many high-yield instruments. While REITs and BDCs can be great for cash flow, their payouts can fluctuate sharply in tough economic cycles. The 2008 financial crisis saw dozens of REITs/distributions. Even in 2020, several high-yield funds temporarily suspended payouts. Meanwhile, dividend aristocrats like Johnson & Johnson, Procter & Gamble, and McDonald's continued raising dividends right through the storm. But here's the twist: you don't have to pick one camp and stay there forever. Investing is engineering. You design your income system to serve your goals. Early in life, your greatest asset is time. Later, your greatest asset is cash flow. The hybrid approach allows you to harvest time when you're young and harvest income when you're older. This approach also helps manage behavioral risk. The high-yield component serves as emotional ballast. Those steady distributions help you stay calm and avoid panic selling when markets dip. You're less likely to make impulsive decisions when your portfolio is still paying you. Now, let's talk about taxes. Dividend growth investing often benefits from favorable long-term capital gains tax rates, especially for qualified U.S. companies. High-yield instruments like REITs and BDCs frequently distribute non-qualified dividends, taxed at ordinary income rates. For a retiree in a high tax bracket, a 7% nominal yield may shrink to 4.5% after taxes. A 3% qualified dividend yield might be worth almost as much after taxes, especially when you factor in consistent growth and compounding. Tax-advantaged accounts like IRAs or Roth IRAs are key. Housing high-yield assets inside tax-sheltered accounts allows investors to enjoy rich income without immediate tax drag. Holding dividend growth blue chips in taxable accounts can be more efficient. Structuring your portfolio intelligently across account types is just as important as choosing the right stocks. Another hidden advantage of dividend growth is its ability to outpace inflation. In the high-yield world, your income may start large but often stays flat, meaning your purchasing power erodes. But in a dividend growth portfolio with payouts growing 8 to 10% annually, your real income actually increases. By year 15, your annual dividends might exceed $15,000, more than doubling your purchasing power even after inflation. That's the difference between surviving retirement and thriving in it. Not every dividend growth stock is a winner. Some companies raise dividends unsustainably. That's why due diligence matters. Focus on payout ratios ideally under 60%, consistent earnings growth, and free cash flow generation. Screen for fortress balance sheets and recession-tested business models. The goal is sustainable dividend growth. In the high-yield arena, enhance safety by diversifying across asset types. Pair equity REITs with mortgage REITs, add BDCs with solid credit underwriting, and mix in covered call ETFs. The key is not yield chasing, it's yield structuring. For the analytical investor, one effective hybrid model is the barbell income strategy. On one end, you have dividend growth stocks, low yield, high growth, rock solid fundamentals. On the other, your high yield instruments, higher income, lower growth, more volatility. The result is a portfolio that's both resilient and rewarding. If you want to amplify long-term results, automation is your best friend. Use dividend reinvestment plans, DRIPS, to automatically buy more shares every time you receive a payout. This is how compounding accelerates. Every dividend buys more income-producing assets, which generate more dividends. Over decades, that flywheel effect turns small contributions into exponential results. Think about psychological returns, the peace of mind from watching your income grow predictably. Markets go up and down, but dividends tend to only move one way, up. When you see that your annual income projection has increased, that's powerful. It gives you confidence, especially during bear markets, that your financial plan is working. Let's not forget about legacy. A well-built dividend portfolio doesn't just fund your retirement, it can create multi-generational wealth. Imagine passing down a portfolio of companies like Microsoft, PepsiCo, or 3M to your children, assets that keep growing their income for decades. You're leaving behind an engine that keeps generating money. Ultimately, every investor's journey will look different. Some may find comfort in the immediate gratification of high yield. Others will find peace in the slow burn of compounding. Both paths can lead to wealth if executed with discipline. The tragedy is when investors abandon their plan midway. The secret is staying the course with a strategy that fits your timeline and temperament. In the end, the choice between dividend growth and high yield is a choice about time. For the young investor with decades ahead, embrace the slow, powerful compounding of dividend growth. Be patient, reinvest everything, and watch your modest investments transform into an income-generating powerhouse. For the retiree who needs cash flow now, high-yield assets are an indispensable tool. But for the vast majority in the middle, the wisest path is a blended, evolving strategy. Start as a growth-focused planter of seeds and gradually transition into a yield-focused harvester of the incredible crop you have cultivated. Please like this video. It truly helps the channel grow. If you haven't already, subscribe and hit the notification bell.